Hi, it's Dave Bolduc with the Bella Group. Welcome to my weekly real estate market update. Today's July 22nd, and inventory is climbing. What's going on? There's a lot of people talking about that, putting out YouTube videos, doom and gloom, or it's great news. What is it? So I just wanted to throw my 2 cents in here, kind of give my perspective, and throw some data in there to back it up and say why I'm thinking what I'm thinking. So before that, click the like button, subscribe, ring the notification bell, standard YouTube algorithm stuff. It helps get the word out to other people, especially if you're getting some value from this. If you think other people should hear the same information, please do that. I'd really appreciate it. In comments, I learned from comments as well. I don't know everything by any stretch of the imagination. This is just something that I'm interested in and focus on. So if you've got a different opinion, a different set of data, something I haven't looked at, please throw it in the comments. It helps for me to refine my point of view and provide better information to everybody. So let's look at the market real quick in general. In Connecticut, 6,512 houses on the market when I checked. It was about 6,350 last week, so about 150 more houses on the market across Connecticut. Very small increase, but it is an increase, so that's a good thing. We sold 54,000 homes last year in Connecticut. Through the first half of the year, we sold 21,000 homes. The second half of the year is usually a stronger sales than the first half. So I'm estimating we'll probably be in the high 40s to 50,000 houses sold this year. What does that mean? Well, that means obviously less houses sold, less houses per month on average sold, which factors into the months of inventory equation, which I'll talk about that in a minute. So inventory's climbing. That's good news. And there's two things in my mind that are really good news about this. And the first one is that buyers have a little bit more time, and the second thing is they have a little bit more choice. What do I mean by a little bit more time? I looked at buyers in the eye 3, 4, 5 months ago and said, we looked at this house that just came on the market today. You have about an hour, and you got to hit it as hard as you can, and hopefully you'll get it because there's 10 other offers on the table. That's not the market that we're in right now. Certainly there are a few houses that are getting multiple offers, but nowhere near as many as there used to be, and you have a little bit more time. So that's great. And then obviously a little bit more selection. So I was taking people out to look at one house. That's it, because that's all there was. Now it's 2, 3, 4, 5. So it's not much more, but it's better, right? It's a little bit better. Unfortunately, it's not a huge increase. It is an increase, but not a huge increase. So how do we measure the number of houses on the market? Number of houses on the market is one. The other one that we use is months of inventory, right? And so the number of houses on the market, you've got a certain number, right? And then you've got houses coming in and you got houses going out. So the houses going out, it could be a house that went under contract that's going to be sold. It could be a cancellation. It could be an expiration of a listing agreement. It could be a withdrawal for some reason. They need to fix something. The cancellations, the withdrawals, the expirations, typically they do work their way back into that active listing pool at some point. But typically the houses that go under contract, they close, right? There are some that will go back on the market. You'll see it listed as BOM or back on the market on the MLS. Those are ones where there was a contract, the seller agreed to a buyer's offer, and then they started doing their due diligence, and for some reason the contract fell apart. The seller still wants to sell the house, so it goes back on the market and it gets added back to that active inventory pool. I'm seeing more, and you can see it in this chart right here. I'm seeing more and more houses come back on the market. So there's something going on there. The other source of listings is new listings. So somebody decides, hey, I'm going to sell my house. Contacts a realtor, they list the house, it's now active. We're seeing pretty much a flat number of houses coming on the market every month. This chart here is showing that over the last 2 months, since the beginning of June, I've been tracking it every single day. And you'll see that Thursdays and Fridays there's a lot more houses that go on the market. Mondays, Tuesdays, not so much. But the average is pretty flat. So that's something that's of interest here. So we have more houses in general on the market, but new houses coming on is flat. So that means that the number of houses going off the market has reduced. And that's what's happened. So I'm going to tell you a little secret here. This is a spoiler alert, so if you need to advance a little bit, go ahead. But here's the secret. This is what the Fed was trying to do. All right, and it kills me to say that, but it's actually working within the real estate market. They're cooling down the real estate market. Interest rates are through the roof. That makes buying a house more expensive. That's just straight up simple math. That's what it is. On top of that, housing prices have climbed over the last 2 years fairly quickly. So more cost to buy the house and the interest payment is higher every month means that fewer people are able to buy. It's really simple. When you got those higher costs, you have lower demand. Think about it in terms of going to the grocery store. Think about it in terms of going out to dinner. If it costs more, you're going to buy less. Same thing with houses. So although it pains me to say it, what the Fed has been trying to do is within the real estate market working. It's cooling down the real estate market. So quick summary here. Yes, inventory is growing slowly. New listings are flat. Number of homes sold per month is down. And back on the market is up. So overall, all that's coming together to end up with more listings or more active houses on the market. But again, in Connecticut, it's like 150 more week over week. If you were to blow that over the month, it's 600 new houses. That's not a lot. And again, why? It's more expensive to buy a house, so there's fewer buyers. And that expense comes in the form of both the price, which has come up dramatically, and the interest rates, which has come up dramatically. So that lower demand has pushed down the number of sales. And I've shown in previous videos charts showing that when interest rates go up, prices don't come down for houses. The number of houses sold come down. And that's exactly what we're seeing right now. So should we be worried? No, this is expected based on the market conditions. This is exactly what the Fed is trying to do. They're actually having the impact that they want on the demand side of the real estate market. They're not impacting the supply side at all, but they're definitely impacting the demand side. Anything can happen, but based on the data that we're seeing, that I'm seeing, the market is returning to 2018, 2019 sales levels. This chart here shows you what's going on. 2020 and 2021, those are aberrations. Extremely low interest rates, a lot of money because of the money printing, and people pushing out of cities because of COVID and everything else that was going on. So it all came together in a perfect storm to really drive up demand. And then a price appreciation is expected to continue. So as I said before, interest rates going up does not drive prices down. It just flattens them out a little bit and it slows down the number of sales. And you can see in this chart that we're expected to see prices continue to appreciate. Not at the 18-20% we saw before, but at 4, 5, 6%, which is still respectable. So moving on to the primary mortgage market survey, which we just talked about. Interest rates are up there at 5.54%. This is actually flat from last week, which is interesting because this week the CPI numbers came out, or it was actually last week, came out at 9.1% for June, and everybody thought everybody was going to go crazy. The stock market did not react at all, or reacted very little, and the mortgage market didn't really react all that much either. And I think that indicates that that everything's kind of priced in. And that they're expecting to see, based on commodity prices, oil prices coming down, that the inflation numbers for July will be down. And so hopefully that is correct. Hopefully we will see that. And I always show this chart. It's really important to keep in mind that we're at 5.5%. And if you look at history, we're in a really good place, especially if you look back into the 70s, the 80s, and even the 90s. The interest rates were much, much higher. I got a comment the other day from a friend of mine. So he remembers back in 81 buying a house at 14% interest rate. So it's real. It did happen. We're at 5.5. So it's not the 2.5, 3 that we were seeing before, but it's still not too bad. And one thing I wanted to leave you with, I just was at an inspection today. Air filters in the air conditioning unit were clogged up and horrible. Please change those things. It's hot out. You do not want your air conditioner working any harder than you need to. So if you have central air, go check those and make sure you change them every 3 months, even throughout the year, because that helps you to have a much more efficient system. Anyway, have a great day. Hope you enjoy the weekend, and we'll talk again soon.